Hi everyone! Today's video is going to be on bonds payable, but in this video we're making it a little bit more complicated and we are adding in interest accruals at the end of the year. And I'm your instructor, Brandy. So in this video, we are going to go through our present value calculation. We're going to go through bond table again, and we're going to go through the journal entries, and the journal entries are where we are going to add in our accrual. If you haven't gone and watched the first video about how to do the bond table, the present value calculation, and the regular journal entries with no accrual, you might want to do that first, and I will post a link in the description for you guys. All right, so in this example, we've got on March 1st, 2019, Drax Corp issued 2-year bonds with a face value of $650,000 and an annual interest rate of 6%. At the time of the bond issuance, the market interest rate was 7% and the bonds pay interest on September 1st and March 1st each year, so twice a year. And Drax Corp has a year end of December 31st. And I just want to make a note that I know both of my examples so far have been 2-year bonds. Bonds can be different lengths than that. I've just done 2 years so that the bond table that we're doing doesn't have to be like 10 lines long. So the first thing we're going to do again is we are going to calculate our present value, or how much cash we're receiving for these bonds. So again, we are the bond issuers. So we are getting money on March 1st, 2019. And then throughout the bond term, so on September 1st and March 1st each year, we are going to pay interest to our bondholders. And then at the end of the term, in 2 years from now, we are going to pay back our bonds. We're going to pay back the $650,000. So what we want to do first is calculate how much money we are getting on March 1st, 2019. And so we're going to use our financial calculator. And again, I use the BA2 Plus, but you're really just looking for these buttons here, the N, IY, PV, PMT, and FV. And we're going to want to fill out all 4 variables except for the PV. The PV, or present value, is the one we are going to calculate for. So our future value, or our face value of our bond, is $650,000. That's the amount we have to pay back in 2 years. Our N is going to be 4 because we have 2-year bonds and they pay interest twice a year. So 2 years times twice a year equals 4. Our IY is going to be the market interest rate of 7% divided by 2, so 3.5. And your PMT is going to be the cash payments we're going to be making to our bondholders every 6 months. So $650,000 times our bond interest rate of 6% divided by 2. So now I'm going to go put those into my calculator. For N, 3.5 IY, 19,500 PMT, and 650,000 FV. Then I'm going to push CPT, compute, and PV. And I got a present value of $638,062. And so these bonds are getting issued at a discount, which makes sense because the bond rate that we are offering is lower than the interest rate the rest of the market is offering. So now let's go through and fill out our table. And again, like I said in the last video, I don't like to call this an amortization table because I find that's very, very confusing. Let's call this a bond table instead. And we can put our headings at the top: date, interest payment, or you could call this cash. That's a cash payment that we're making every 6 months. Interest expense, that's what's going to go to your income statement. Reduction of discount, discount balance, and bond carrying amount. And your titles do not have to be the same as mine, just as long as they make sense, or ask your teacher what they want them to say. On March 1st, when we first issue the bonds, we put our present value, or the amount that we are receiving for our bonds, the cash amount, in the bond carrying amount. So that's that $638,062. That PV is going to get put into that bond carrying amount column. The discount balance is going to be the difference between the $650,000 and the PV that we have calculated. So $650,000 minus $638,062. So on March 1st, 2019, our discount balance is sitting at $11,938. On September 1st, 2019, our interest payment, or our cash payment, whatever you wanted to call it, is going to be calculated by taking the bond face value of $650,000 times 6%, which is the bond rate, divided by 2, because the 6% is an annual interest rate and we are making payments every 6 months. The interest expense, again, this is where it gets strange, by taking our bond carrying amount of $638,000 times our market interest rate of 7% and divided by 2. So I got an interest expense of $22,332. The difference between the cash payment and the interest expense is going to go into the reduction of discount column. So we're going to put $2,832 here, and that amount is going to reduce the discount balance. So $11,938 minus the $2,832 is going to give us our new discount balance of $9,106. Our new bond carrying amount can be calculated two ways. The first way you could calculate it, if you want to, is by taking the old carrying amount, so $638,062, and adding in the reduction of discount of $2,832. Or you could also calculate this as taking the total bond amount of $650,000 and minusing the discount amount of $9,106. They both come out to the same amount, so whichever way feels more comfortable for you, that's the way you should use. So our cash interest payment again is the $19,500. And we're going to get that by taking the $650,000 times 6%, which is the bond interest rate, divided by 2. Our interest expense for March 1st is going to be the bond carrying amount, the new amount of $640,894, and multiplying it by the market interest rate of 7% and dividing it by 2. So we get an interest expense of $22,431. The difference between the interest expense and the cash payment is going to go in the reduction of discount column, and that amount is going to reduce our discount balance. So our new discount balance can be calculated by taking the $9,106, the old discount balance, and subtracting the $2,931. Our new discount balance is sitting at $6,175. Our new bond carrying amount can be calculated by taking the old carrying amount of $640,894 and adding in the reduction of the discount of $2,931, or again, you can take $650,000 and subtract the discount balance of $6,175. Either way gives you the same number, $643,825. And I've realized that I need one more line or else this table isn't going to work, so I'm just going to add in another line to my table. All right, so now on September 1st, 2020, again, our cash payment is $19,500. Our interest expense is going to be calculated by taking the new bond carrying amount, $643,825, multiplied by our market interest rate divided by 2. The difference between the interest expense of $22,534 and the cash payment of $19,500 is going to be $3,034, which is going to reduce our discount balance. Our new bond carrying amount can be calculated by taking the old carrying amount of $643,825 and adding in the reduction of discount of $3,034 to give us $646,859. Or you could take the $650,000 and subtract your discount balance to get the same amount. And finally, we're going to do the last line in the table, which is where we see if everything works out, and we're crossing our fingers that it does. On March 1st, again, we make a cash payment to our bondholders of $19,500. Our interest expense is calculated by taking our bond carrying amount, $646,859, and multiplying it by the market interest rate divided by 2. Now we're crossing our fingers that our reduction of discount is equal to the old discount balance. And as you guys can see here, we're off by $1. So our discount after all of our work would still be $1. So this wouldn't work out perfectly. I don't actually mind if you leave it like this. That's fine. It's not a big deal. But if you want it to be absolutely perfect, which let's be honest, most of us do, you can change the interest expense so that your new reduction of discount perfectly equals the discount balance. So as you can see, I've changed the 0 on interest expense to a 1. And so now my reduction of discount is 3141. And now that reduces my discount balance down to 0 perfectly. And then we'll have a whole bunch of happy students. So our new bond carrying amount is $650,000, which is exactly what we want it to be. We want it to match the future value or the face value we identified at the beginning of the question. So this is good news. That means we're ready to move on to our journal entries. So now when we do our journal entries for this question, we are going to do the first journal entry setting up the bond. We are going to do our interest journal entries, but we're also going to accrue interest at December 31st each year. Then at the very end, we're going to make our journal entry to pay back our bondholders. All right, so on March 1st, 2019, we calculated that our present value was $638,062. And so that is the amount of cash that we are getting on March 1st. So to put this into our journal entry, it's going to be debit cash $638,062. Our bonds payable account, we're going to set up as a credit for the full $650,000 that we owe to our bondholders at the end of 2 years. If you guys are accounting students, you're going to start getting that funny feeling in your stomach because you can see that your debits and your credits don't balance, and that makes us very uncomfortable. So in order to balance this out, we need a debit, and the debit that we need is the discount balance from our table of $11,938. We can set this up as an account called Discount on Bonds Payable. And if we were to look at our balance sheet right now, we would see the bonds payable account sitting as a liability at $650,000 and the discount on bonds payable account of $11,938. That is reducing the balance of the bonds payable so that the net value of that bonds payable account is going to be the $638,062, which is our carrying amount in our table. All right, now we get into our interest journal entries. On September 1st, 2019, this is just a normal interest payment journal entry. So we are going to record interest expense debit, $22,332, credit cash, $19,500, and the difference between those two things, the $2,832, is going to be credited to discount on bonds payable. I'm going to check off on my table that I have dealt with the September 1st journal entry. We're going to tell our brains we don't need to worry about that anymore. The next journal entry we're going to do is for the interest accrual at December 31st, and we want to make sure we're actually focusing on the next line of numbers in our table. So the amount of time between September 1st, 2019, when we have done our last journal entry of March 1st, 2020, is 6 months. It's a 6-month period. We are going to make an accrual entry. And again, accrual means something's happened, but no money has changed hands. So in this case, we owe our bondholders money, but we haven't actually paid them yet. And we owe them money because we owe them interest. So we want to record the interest expense up until December 31st. So between September 1st and December 31st is 4 months, and you can count the months on your fingers if you want to. September, October, November, and December. In order to do our calculations for our journal entry, we are going to take the amounts in the table from March 1st, 2020, and we are going to multiply them by 4/6. So our interest expense, which is going to be our debit, will be calculated as $22,431 times 4 months over 6 months. We aren't paying out any cash at December 31st. So instead of cash, we're going to write interest payable, and this is going to be calculated as $19,500 times 4 months divided by 6 months. The difference between those two numbers, the debits and the credits, because again, our journal entry needs to balance, is going to be credit to discount on bonds payable. And again, we are reducing the discount on bonds payable account by crediting it, and so eventually by the end of the 2 years, this discount on bonds payable account will go down to 0. And so that is your accrual journal entry at December 31st, 2019. When we actually do our journal entry to pay out the $19,500 on March 1st, 2020, we need to record an extra 2 months of interest expense as well. And so I'm going to give you 2 ways to do this, and you guys can decide which way you like better. Do you like option 1 better, or do you like option 2 better? And don't worry, these will get you to the exact same place. Option 1 is going to be to record your payment and the remaining 2 months of interest in one journal entry. So we're going to calculate our interest expense as 22,431 times 2 months for the remaining January and February leading up to March 1st and divided by 6 months. And so we get $7,477. I also need to clear out my interest payable account because after I pay this out, I don't owe the bondholders that money anymore. So I'm going to debit $13,000 and I just copied that amount from my December 31st journal entry. My discount on bonds payable account is going to be credited, and we can calculate this by taking the $2,931 from our table and multiplying it by 2 divided by 6. Again, 2 months over 6 months. And the cash amount that we have to pay is from our table is the $19,500. And so that will be a credit to cash. Okay, so that is option 1. So for option 2, you are going to completely reverse the year-end accrual. So we're going to just flip the December 31st journal entry and pretend it never happened. And then we're going to do the normal journal entry on March 1st, 2020. Okay, the first thing you do is completely flip your December 31st journal entry. You're going to credit interest expense and you are going to debit discount on bonds payable and you're going to debit interest payable. So debit discount on bonds payable 1954, debit interest payable 13,000 and credit interest expense 14,954. Now that I've reversed that journal entry, it's like it never happened. So now I can just go back to my table and make my normal March 1st journal entry and pretend my December 31st accrual never existed in the first place. So debit interest expense 22,431, credit discount on bonds payable 2,931, and credit cash 19,500. And now we can move down the table and do our September 1st, 2020 journal entry. And again, there's no year end between March 1st and September 1st. This is going to be a regular old interest expense journal entry. Debit interest expense, $22,534, credit cash, $19,500, and credit discount on bonds payable, $3,034. Again, we're reducing the discount on bonds payable account, and it's going slowly down to 0. Now, the next entry we're going to have to do again is a year-end accrual once again because that silly December 31st is getting in our way. So we have to update our interest expense and update our interest payable so we can create our financial statement. So we're going to do the same process we did at December 31st, 2019. We are going to take the interest expense amount of $22,641 and we're going to multiply it by 4 months divided by 6 months. We are going to take the cash amount of $19,500 and multiply it by 4 months divided by 6 months. But because we're not paying cash, we are going to credit interest payable because we're going to pay this in the future, and that will be our liability. And then the difference between those two amounts is going to reduce our discount on bonds payable once again. Now at March 1st, 2021, which is going to be our last interest payment, again, I'm going to run through the two options for you. So option 1 is just to record the interest expense for the remaining 2 months, clear out that interest payable account, record the reduction in discount on bond payable for the remaining 2 months, and then pay out your cash for $19,500. I'm doing the calculations slightly different this time just to show you a different way of doing this. So this time, instead of multiplying my interest expense amount by 2/6, I'm just taking the total amount and subtracting the amount I've already recorded at December 31st. And so my interest expense is $7,547. And again, you could still multiply this by 2/6 and you will get the same amount. My interest payable account, I'm going to debit for the full $13,000 because I'm clearing out that account. After this journal entry and after this cash payment, I don't owe the bondholders this interest anymore because it's been paid out. My discount on bonds payable is being calculated as $3,141 from my table minus $2,094. And I know I'm paying out cash of $19,500. So that is going to be credit to cash. And so that's option 1. Again, option 2 is going to be to completely reverse the December 31st accrual and then put in a normal March 1st, 2021 journal entry. So first, in order to reverse my December 31st accrual, I'm going to debit discount on bond payable $2,094, debit interest payable $13,000, and credit interest expense for $15,094. And step 2 is just to look at my table at my March 1st, 2021 line and record my interest expense journal entry. debit interest expense $22,641, discount on bonds payable $3,141, and credit cash $19,500. And again, just choose one of these options. Please don't do both. And so now after we do that journal entry, if we were to take a snapshot of the balance sheet, after we pay out our interest, but before we pay out the actual bond, which is kind of silly to think about, but let's take a look at what it would look like. So on March 1st, 2019, we were sitting at a balance of $650,000 and our discount was at $11,938. Our discount got reduced down to $6,175. And on March 1st, 2021, if for whatever reason we created a little balance sheet just after we paid out our last interest payment, but before we paid out the principal of the bonds of $650,000, this is what it would look like. It would show $650,000 sitting as our liability as bonds payable. Discount on bonds payable account has been now reduced down to zero. And so the net carrying value of our bonds payable account is sitting at $650,000. So now we can completely clear out that bond account. And in order to do that, we are going to debit our bonds payable account and we are going to credit cash. And thanks for sticking with me on that one. I know bonds payable is quite a lot of work, so good work getting through it all. So now after watching this video, I'm hoping that you guys can calculate your present value, you can make a bond table, and you can do your journal entries with year-end accruals on bonds payable that have a discount on it. That's a lot of work. Thanks for watching, everyone.